G'day founders, I'm Chief, and today we're diving deep into the art and science of securing investment, especially for you intrepid Aussie innovators. Now, a lot of folks believe fundraising is a numbers game, just a cold, hard transaction based purely on spreadsheets and projections. But I'm here to tell you, from countless conversations with founders who've scaled mountains, that the real currency in the early stages isn't just your TAM or your MRR, it's the story you tell. Sure, data provides the evidence, but narrative provides the conviction. It's the compelling story that lodges in an investor's mind long after the deck is closed, transforming a maybe into a resounding yes. These aren't just abstract theories, these are battle-tested principles that can dramatically shift your fundraising trajectory. In a crowded marketplace where every startup claims to be the next big thing, a powerful narrative, coupled with strategic insights, is what makes you memorable. It's what allows you to cut through the noise, to connect on an emotional level, and to demonstrate not just what you're building, but why it matters, and why you are the one to build it. Mastering these fundraising secrets will equip you to stand out, to build genuine momentum, and ultimately, to secure the capital that fuels your vision. So, if you're ready to move beyond the conventional wisdom and learn how to truly captivate investors, you're in the right place. We're going to unpack 5 crucial secrets that can transform your approach, helping you not just ask for money, but to forge genuine partnerships. These are the insights that separate the startups that merely pitch from the ones that truly connect and secure the backing they need to change the world. Let's get into it. The first secret, and honestly it's probably the most foundational, is to lead with a compelling narrative, not just a meticulously crafted slide deck. So many founders fall into the trap of believing that if they just present enough data points, enough charts, enough market sizing, investors will inevitably see the brilliance of their idea. But here's the thing. Investors are human. They are moved by stories, by vision, by the palpable passion of a founder who sees a future others haven't yet imagined. Your deck should support your story, not the other way around. Think of it like this. Your data is the skeleton, but your narrative is the heart and soul that brings it to life, that gives it purpose and direction. A powerful story creates an emotional connection that raw data simply cannot replicate. It allows an investor to step into your shoes, to feel the problem you're solving, and to believe in the future you're painting. When you tell a story, you're not just conveying information, you're inviting them on a journey. You're showing them the why behind your what. This conviction, this shared belief, is often the tipping point in an investment decision. I've seen pitches with flawless metrics fall flat because they lacked a soul, and conversely pitches with early, perhaps less polished data, succeed because the narrative was utterly undeniable, painting a vivid picture of potential and impact. Consider the most iconic companies, Apple, Airbnb, Tesla. Their initial pitches weren't just about technology or market share, they were about changing how we live, connect, and move. They told stories of empowerment, community, and revolution. Your narrative should encapsulate the problem, your unique solution, the team's passion, and the grand vision. It's about making the investor feel like they're not just betting on a business plan, but on a movement, on a team that can overcome obstacles because their belief is unshakable. This is where you articulate the dent you plan to make in the universe. So, before you even open PowerPoint or Keynote, ask yourself, what is the core story here? What is the human element? How can I make this problem and my solution resonate on a deeper level? Craft that narrative first. Let it be your guiding star. Let it inform every slide, every talking point, every interaction. Because when you lead with a story, you're not just seeking capital, you're seeking true believers, partners who are as invested in your mission as they are in the financial return. This is how you build a company that lasts. Once you've crafted that compelling narrative, the next crucial step is to prove, unequivocally, that the problem you're solving isn't just a minor inconvenience. It's an immediate, acute pain point for a significant group of people. Investors, especially in the early stages, are looking for solutions to problems that are so pressing, customers are actively, sometimes desperately, seeking a fix. It's not enough to say this would be nice to have. You need to demonstrate that your target audience is currently experiencing significant friction, loss, or frustration because your solution doesn't exist yet. This urgency is what creates market pull. How do you prove this immediacy? Through evidence, and lots of it. This is where your research, your customer interviews, your early traction, and your pilot programs become incredibly powerful. Don't just state the problem, illustrate it with real-world examples, with testimonials from potential customers who can articulate their pain. Show investors the makeshift solutions people are currently using, the time they're wasting, the money they're losing. The more tangible and visceral you can make the problem, the more compelling your solution will appear. Think of it as diagnosing an illness. The more clearly you define the symptoms and their severity, the more valuable the cure becomes. This isn't just about identifying a gap in the market, it's about showcasing a bleeding neck, a problem that demands immediate attention. Investors want to see that you're not just building something innovative, but something that people are clamoring for. Are there forums where people complain about this issue? Are there industry reports highlighting this specific challenge as a major bottleneck? Have you run surveys that quantify the frustration or the cost of this problem? Bring this evidence to the forefront. This isn't just about your perception of the problem, it's about demonstrating that the market itself recognizes and feels this pain intensely. Furthermore, this immediacy creates a natural barrier to entry for competitors, and a strong incentive for early adoption. If the pain is severe enough, customers will be more willing to try a new solution, even if it's from an early-stage startup. They'll be more forgiving of initial imperfections if it alleviates a significant burden. So, dig deep, get specific, and provide concrete proof that the problem you're tackling isn't just a theoretical construct but a burning, real-world issue that needs solving now. This urgency underpins the entire investment thesis. Alright, so you've got your compelling narrative and you've proven the urgency of the problem. Now let's talk about the money itself. Secret number 3 is to treat capital as a strategic asset, not just as generic fuel to burn. Many founders approach fundraising with a simple request: we need X amount to grow. But sophisticated investors want to understand precisely how that capital will be deployed to create specific, measurable outcomes, particularly in terms of growth and building a defensible moat around your business. They're not just giving you money, they're entrusting you with a resource to build value. You need to articulate a clear, well-reasoned plan for how every dollar invested will contribute to key milestones. Will it be used to scale your sales team, leading to a projected X increase in customer acquisition? Will it fund crucial R&D to develop a feature that locks in customers and creates a significant competitive advantage? Will it be deployed to expand into a new lucrative geographic market? Be specific. Show them the levers you intend to pull and the expected impact on your key performance indicators. This isn't just about spending money, it's about making strategic investments within your business. Think of it like a general deploying troops and resources on a battlefield. Each deployment has a strategic objective. Similarly, your use of funds should be tied directly to achieving critical business goals that increase your company's valuation and reduce risk. This demonstrates to investors that you're not just hoping for growth, but that you have a concrete plan to achieve it. It shows financial discipline, strategic thinking, and a deep understanding of your business model and its drivers. Investors want to see that you're a responsible steward of their capital, capable of making smart, high-leverage decisions. Moreover, when you articulate how funds will build defensibility, perhaps through intellectual property, network effects, or by achieving economies of scale faster than competitors, you're showing investors how you plan to protect their investment in the long run. It's not just about short-term gains, it's about building a sustainable, market-leading enterprise. So don't just present a budget. Present a strategic allocation plan that clearly links capital to value creation and competitive entrenchment. This level of clarity and foresight is what gives investors confidence that their money will be a catalyst for significant, defensible growth. This next secret might sound counterintuitive, especially when you're deep in the fundraising trenches and capital feels like oxygen. Be willing to walk away from a deal. It's a powerful stance. The ability to say no to terms that are misaligned with your vision, your values, or your company's long-term health is not a sign of arrogance, but of strength, conviction, and a deep understanding of your own worth. Investors are looking for founders who are not desperate, but discerning. Founders who are building something of such significant potential that they won't compromise its future for a quick check. Walking away, or even signaling your preparedness to do so, can dramatically shift the power dynamic in a negotiation. It communicates that you have options, that you believe in your trajectory with or without this particular investor, and that you prioritize the right partnership over just any partnership. This doesn't mean being difficult or unreasonable. It means having clear boundaries and a non-negotiable set of principles for what constitutes a good deal for your company. When an investor sees that you're willing to protect your company's interests, even at the risk of losing their investment, it can ironically increase their respect for you and their desire to be involved. Think about it. If you readily accept unfavorable terms, what does that signal about your confidence in your own venture or your ability to negotiate future critical deals for the company? Investors are often testing your resolve and your business acumen. Your willingness to stand firm on key points demonstrates that you'll be a strong leader who will fight for the company's best interests down the line, whether it's with future investors, key hires, or major customers. This is a critical leadership trait they want to see. Of course, this requires a degree of self-assurance and ideally, some leverage, perhaps interest from other investors or strong organic traction. But even without overt leverage, a principled stand based on a clear vision for your company's future is powerful. Know your walkaway points before you even start negotiating. Understand what terms would cripple your ability to operate effectively or dilute your team unfairly. Being prepared to decline a misaligned offer isn't just a negotiating tactic. It's a fundamental aspect of building a resilient and successful company on your own terms, ensuring you bring on partners who truly share and support your long-term journey. The final secret we're unpacking today is one that plays the long game: build genuine relationships with potential investors before you desperately need their money. So often, founders only start thinking about investor outreach when their runway is dwindling, leading to rushed transactional interactions. This is a mistake. Fundraising is fundamentally about people investing in people. And trust, the bedrock of any strong investment partnership, isn't built overnight or through a single pitch meeting. It's cultivated over time through consistent, authentic engagement. Start identifying investors who align with your sector, your stage, and your values long before you plan to raise your next round. Follow their work, understand their investment theses, and engage with their content thoughtfully. Seek opportunities for warm introductions, not to pitch immediately, but to ask for advice, to share your progress informally, or to discuss industry trends. The goal here is not to extract capital, but to build rapport and establish yourself as a credible, thoughtful founder in their network. Think of it as planting seeds that may one day grow into fruitful partnerships. When you approach an investor with whom you've already established some level of connection, the conversation is entirely different. It moves beyond a cold evaluation of your deck to a discussion between individuals who have some existing context and mutual respect. They've seen your progress over time, they've had a chance to gauge your character and your commitment. This preheating process makes the formal fundraising ask much warmer and significantly increases your chances of not just securing a meeting, but of having a truly productive dialogue that could lead to investment. Remember, investors talk to each other. A good reputation and a network of genuine relationships within the venture community can be incredibly valuable. These early, non-transactional interactions also give you a chance to soft-sound your ideas, get valuable feedback, and refine your pitch before you're officially in fundraising mode. So, make networking a continuous, strategic activity. Attend industry events, participate in relevant communities, and don't be afraid to reach out for informational conversations. Building these bridges before you need to cross them is one of the smartest investments of your time as a founder. So there you have it, 5 fundraising secrets that I believe can fundamentally change how you approach securing capital for your Aussie startup. From leading with a powerful narrative to proving the immediacy of the problem, treating capital strategically, being willing to walk away, and crucially, building relationships before you need them. These aren't just tactics, they're pillars of a robust fundraising strategy. Remember, successful deals are rarely just about a founder's charm or a slick presentation. They are an alchemy of the right story, told at the right time to the right people. It's about demonstrating not just potential, but a clear path to achieving it, backed by evidence and driven by a narrative that resonates deeply. Investors are looking for conviction, and that conviction is built through a combination of compelling storytelling and strategic foresight. Your ability to articulate your vision, prove your market plan, your resource allocation, negotiate from strength, and cultivate genuine connections will set you apart in the competitive landscape of fundraising. It's this holistic approach that transforms a hopeful pitch into a funded reality. Ultimately, securing investment is about forging a partnership. It's about finding individuals who not only provide capital but also believe in your mission and can add strategic value to your journey. By internalizing these secrets, you're not just learning to ask for money more effectively, you're learning to build a more resilient, compelling, and ultimately, a more fundable company. So go out there, tell your story, build those relationships, and secure the resources you need to scale your incredible Aussie innovation. Cheers to your success.